Afternoon, and we're going to get started. I'm Jeff Whitaker with Jackson and Whitaker, and we welcome you here on our webinar. We've got a lot of people signed up for this. I think that's the most we've ever had. So this is a topic of great interest. There's still people signing on. It's a beautiful day here in northern Nevada. It's springtime-like weather. It's about 65 degrees outside, nice sunny, puffy clouds. So thanks for coming inside for a little while to join us to talk about a fascinating topic of income taxes. We're going to be covering the One Big Beautiful Bill today. Um, I'm sure there will be questions, and that's fine. If you look at the bottom of your Zoom screen, you'll see a little box that says chat. If you click on that, you can type in your questions. If it's something we don't know the answer to, we won't even talk about the question. But if it's something we can help with, we'll address those questions. And if you do make questions, they should be of a general nature. If you got things that are more a personal situation, best to talk to one of our advisors or me, and we'll try to help you with that. This is being recorded. We've had a lot of requests for replays on it. It will be on our website, jacksonandwhitaker.com. And we also have LPL's quick view tax guide that they prepared that most of this information is taken from. If you would like a copy of this, communicate with us somehow and we'll see that you get one. The recording will also be available probably in a week or so on our YouTube channel as well. So we'll jump right into the topic and see where this goes. I think to understand the One Big Beautiful Tax Bill that was passed on July 4th last year and signed by President Trump, it's important to understand the tax bill that was passed 10 years ago, and it was the Tax Cut and Jobs Act. It was passed on December 22nd of 2017. And had this bill not passed, the one we're talking about today, the provisions of the bill that was passed in 2017, the term they used is would have sunset, and which means they would have gone away. And it would have meant an automatic, massive tax increase for people in the country and for businesses. Just to give you an idea of some of the things that would have happened automatically had the bill not passed, we would have seen the tax rates increase anywhere from 7% to 25%. The biggest increase at the lower tax brackets, the lower incomes, we would see the 12% bracket go to 15, the 22% bracket go to 25, the 24% to 28, the 37 to 39.6. And when you add on some of the extra taxes from the Affordable Care Act a few years earlier, it would have been a maximum tax rate of 43.4%. The children's tax credit would have been cut in half from $2,000 down to $1,000. The standard deduction, this is the amount of money that you can have every year that you pay no income tax on. It would have been cut in half. The estate tax exemption would have been cut in half. There would have been a resumption of penalties for not enrolling in health insurance. Some of those penalties got pretty severe. Corporate taxes would be increased from the current 21% on corporate profits to 35%. It's a 67% increase. And there'd be major reductions in depreciation deductions that businesses could take. For small businesses, particularly those that are of a pass-through nature, so think about subchapter S corporations, LLCs, or limited liability companies, self-employed individuals. They don't pay taxes on their business entity. The income from their business passes through to their individual tax return, and they'd pay tax on their business at the individual tax rates, which at the time would have been the highest tax rates on business in the developed world. And so the Tax Act from 2017 put together a special deduction where businesses that pass their profits through to their personal return, they would be able to take a 20% deduction of those profits, effectively lowering the tax on their businesses. That would have been eliminated. So most people would have seen a very significant change in income tax had the one big beautiful bill not passed. All of those things would have happened automatically. And this is something that doesn't get discussed very much, but it's of major consequence. Many of those provisions that were in the 2017 bill were made permanent in the big one big beautiful bill. Now, this bill, both of these tax bills were signed by President Trump. And I know there's quite a political divide in today's world. Some people love President Trump and like his policies. Some people do not like President Trump or his policies. We don't want to get too political in this. I think there's it's a big tent and there's room for lots of opinions on things. And what we're going to take the old, you remember the old television series Dragnet with Sergeant Joe Friday? And his favorite line was just the facts. And we're going to look at just the facts today on these things. And it will be very difficult to understand everything. There's a lot of moving parts, a lot of ins and outs of these provisions. Don't try to become a CPA and learn all of these things, but look for those areas that will impact you or people you care about and how it might impact the overall economy. So with that, I'm going to share my screen and we'll start looking at some of the provisions of the big beautiful bill. Okay, I suspect someone from the office will run in here and tell me if you're not seeing this. So we're glad you're here with us. And here's our agenda for today. We're going to look at the key changes in 2025 and beyond. There will also be some other provisions that we're going to touch on that were part of the Secure Act and the Secure 2.0 that kind of tie in. We'll talk about things that are staying the same. And we want to look at some planning opportunities from this and also some traps that are out there and things to watch out for. And we're going to try to keep this in pretty simple terms. The bill is very complicated and very lengthy. And, you know, in 25 or 30 minutes, we're only going to be able to cover some of it. And the bill had a lot of other provisions besides the tax aspect. We're only going to be talking about the tax aspects of the bill. As I mentioned, don't try to be a CPA unless you are one. Still need to work with good tax counsel, work with your advisors on things that may be of interest or pertinent for you. I would mention that here in the office, we have some tax software. It's from a company called Holistiplan, and we can illustrate some of these provisions and how it might apply to your own tax return on that software, and you can see if these things help you or not. So let's talk about the standard deduction. This is a very important part. Everybody gets one. And this is income. It's a series of deductions that you get, and you don't have to pay any tax on this income. And you get to take either the standard deduction as it's listed or the greater of your itemized deductions if you have enough itemized deductions to go over. Those were largely reduced in the Tax Cut and Jobs Act from 10 years ago, but you can still deduct a certain amount of mortgage interest only on the first $750,000 of mortgage. You can still deduct your property taxes. You can still deduct any state income taxes. Um, and we'll talk a little more about that because that has changed. And you can deduct your charitable deductions. For many people, especially for those of us here in Nevada, we don't have a state income tax. Property taxes are relatively low, and many of our clients have their mortgages paid off. So there's not a lot of itemized deductions, and they get to take the standard deduction. So for a married couple, it's 31,500 for 2025. It got a bump for up to 32,200 for 2026. And it's half that amount if you're single. Now, for those who are 65 or older or blind, they get some additional deductions. If you're single, you get and over 65 again, you get 2,050 in additional standard deduction. If you are married, you get 1,650 each for each spouse. So that would be a total of $3,300 in additional standard deductions. Now, one of the things that is new in the big, beautiful tax bill are is an additional deduction for seniors. This is a temporary deduction. It goes for 4 years. It is retroactive to January of 2025. So as you're filling out your tax returns for last year, you can take this deduction. And it's $6,000 a person. For a married couple, that would be $12,000. This is in addition to your standard deduction. Also, if you have enough deductions to itemize, this is in addition to your itemized deductions. And then there is as is the case with most of these provisions, at some level of income, you don't get the deduction. It phases out. It begins phasing out for singles at 75,000 in gross income, and for a married couple, 150,000. It fully phases out after another 10,000. So 85,000 for single and 160,000 for a couple. There'd be no benefit from this. And it's available for 4 years only. Interesting that 2028 is another presidential election year. I think there's some political strategizing that's going on with some of these deductions. So here's how these things can work together. So for someone who is single and 65, you take the standard deduction, the increased standard deduction, plus the temporary 6,000. They've got $23,750 of income that they pay no federal income tax on. For a married couple, it goes up to 47,500 of tax-free income. Now, here's a point that gets a lot of confusion. We get a lot of calls where people are saying there's no tax on Social Security. Isn't that great? And even today, I heard Vice President Vance on television talking about the tax bill, and he used the words no tax on Social Security. And it's sort of correct, but you have to kind of get there in a roundabout way. If we look at what most people get in Social Security, a couple $1,000s a month, and for a married couple, they've got $47,000 with the standard deduction, the extra standard deduction, the special deduction for over 65. We're coming up with figures that are very close to what people get in Social Security. So for a large part of the population, the majority, if not all of their Social Security will not be taxed because of all of these deductions put in place. But to use the blanket statement, and just assume there's no tax on Social Security. It won't work when you prepare your return that way. And for some people with higher incomes, it won't work as well. So another deduction that we see is there is no tax on tips and overtime. This is temporary as well, just for 4 years. Goes from retroactive to 25 up through 2028. For tips, it's 25,000, both for single and for married. Um, and currently, your employer has to report on a separate line your income that you receive from tips. It's actually a fairly complicated process that employers have to go through to report tip income on the W-2s. They've had to do that for some time. So should be a fairly easy thing to take the deduction on your tax return. It is retroactive to 2025. The overtime deduction is different for single and married, 25,000 for married, 12,500 for a single. And you can have both. Many people in the service industries may have, or people who are hourly, they may have both tips and overtime that they can take deductions. Just before we started this webinar, our bookkeeper dropped by the office to pick up some things, and she was telling us that she does tax returns as well. She was telling us that many of her clients that get tips and overtime that had to pay taxes when they file their return are now getting refunds. These phase out at higher income levels, different than the phase out for the senior deduction. It's $150,000 annual gross income and 300,000 for marrieds. The child credit continues and has been enhanced. Um, the the bill passed in 2017 increased the child credit from 1,000 to 2,000, and it is adjusted by inflation, so it's now 2020. And now there is an additional children's tax credit that is partially refundable. When we say a credit is refundable, let's talk about what that means. A credit is different than a deduction. A deduction is reducing your income that you pay taxes on. A credit is a direct reduction in the tax. So credits are very valuable, more valuable than deductions. And a refundable credit is a situation where maybe between your deductions and credits, you end up owing no federal income tax. But if you still have some of this credit left, it's refundable to you and you would get it as a refund. So this is a way some families pay no income taxes and still get a tax refund. It's from these refundable credits. It does phase out 200,000 for singles, 400,000 for married. And um, I checked this several different ways. I was doubting myself, thinking you can get both. But so far, everything I saw you can collect both the children's tax credit and the additional tax credit if you're in the eligible income categories. And this provision is made permanent. It does not have a sunset provision like the original 2017 law did. Let's go back to the Social Security question and talk a little bit about how Social Security is actually taxed. And these rules were last changed in 1984. They have not been updated since then. And originally, Social Security was not taxable at all. It didn't make a lot of sense to tax Social Security because you didn't get to take any deductions when you paid into the system. you paid into Social Security with after-tax money, and it doesn't make a lot of sense for you to send money to the government, for the government to send money back to you, for you to send the money back to the government. That seems rather silly. But in 1984, Congress and the president were looking to find ways to shore up Social Security so it did not run out of money. So they decided if you are rich, you probably should pay a little bit of tax on your Social Security. And very interesting to see what they decided was considered rich. For a single person, it was income, gross income, including half of your Social Security, of 25,000 to 34,000. That's rich, and so you should pay taxes on 50% of your Social Security income. If you're super rich, that's 34,000 for a single. Now you should pay tax on 85% of your Social Security. A little higher qualifications to be rich and super rich for married, 32,000 for rich and 44,000 for super rich. Now that's what they did in 1984. Unfortunately, there have been no cost of living adjustments to that, and so the same figures apply today. And so most people, if they have any income other than Social Security from investments or pensions, they end up paying some taxes on their Social Security. But then the standard deduction kicks in, the extra standard deduction kicks in, the senior deduction of 6,000 a person kicks in. So a lot of that income may not be actually taxable because of those reasons. A lot of confusion on this point. How are capital gains and dividends taxed? Um, Capital gains occur when you buy an asset. It could be real estate, it could be a stock, it could be a mutual fund. You buy it at one price and you sell it at a higher price. That gain is considered a capital gain and it's taxable, but it's taxed at a different rate. Um, and if you are in the 12% tax bracket, the rate on capital gains and qualified dividends is actually zero. What is a qualified dividend? A qualified dividend is a dividend that's paid from public companies and the stock you own in those companies, either owning the stock of the company directly or through a mutual fund or ETF. So this is a bit of a tax break. This is not new. This has been there for a while, but the rate stays 12%. It didn't jump up to 15%. And for some people, they can have no taxes on their capital gains or qualified dividends. For a single person, you stay in the 50% bracket up to a taxable income. This would be after your deductions of 50,400. For a married person, you stay in the 12% bracket up to 100,000 of taxable income. Taxable income is after you take the standard deduction. So if we were to talk in terms of gross income, depending on a person's age, we're looking at about 65,000 to 70,000 for a single person and 130 to 145,000 for a married couple. No tax on dividends, capital gains. If your income goes over that, it puts you into the 22% bracket and you start paying tax on them again. This was originally put in place to encourage long-term investing. Uh, to be a long-term capital gain, you have to hold the investment for a year and a day. And it also solves a problem that exists in corporate taxes in that when a corporation pays out a dividend, it is paying a dividend after it has paid its corporate tax. So when it's taxed at the individual level, that that money is being taxed again. And so Originally, you didn't pay taxes on dividends, but government needs more money, so at certain income levels, they decided to put some tax on it, but at a reduced rate. There's some new rules on charitable giving. This is new for 2026. For non-itemizers, these would be people that take the standard deduction and they're not really getting any additional write-offs for making a charitable contribution. They can get they refer to it as an above the line deduction. So it's before we even start looking at the standard deduction or your itemized deductions. So this would be in addition to the standard deduction. Or in addition to your itemized deductions. You get $1,000 deduction of income for single, $2,000 for married, for any charitable contributions that you make to your your college, your church, the Red Cross, any organization that's set up as a nonprofit charitable organization. And it's just a straight deduction right off the top. It's not considered part of the itemized deductions, so everybody would be able to keep track of this. So if you're like a lot of people and you give $100 here and $100 there to different charities that you want to support, in the past that wouldn't have made a lot of difference to you if your itemized deductions didn't add up to go over the standard deduction, but now those things would. So you ought to keep track of that. You know, if you're married and you're in the 12% tax bracket, a $2,000 deduction saves you $240 of income taxes. You might as well take that as not. I haven't seen anything from the IRS as to what kind of documentation is required for that. I suspect it would only be required in the event of an audit. For those who itemize their deductions, there is a change in what you can take as an itemized charitable deduction. Um, you can take, you can still take your charitable deductions, but you have to reduce them by 5%, or I'm sorry, 1/2 of 1% of your adjusted gross income. So let's take an example here. Um, I got to be able to do the math on my fingers. So let's take an adjusted gross income, that's before deductions, of $100,000. Um, one 1/2 of 1% or 0.5% would be $500. And let's say you donated $10,000 to your church. You would only be allowed a deduction of 9,500. You have to reduce the deduction of the charitable contribution by 1/2 of 1%. Um, the government does the same thing on medical expenses, but it's 7.5% of your AGI. And one question that we do not answer is why did the government do this? I have no idea, but it does make things a little more complicated. Okay, let's talk about savings for retirement. A few changes here. Um, the limits have increased for IRA contributions. When IRAs first came out back in 1976, it was a $1,500 maximum contribution. For those under age 50, it's now 7,500 for 2026. And for those that are 50 and over, it's 8,600 is the maximum contribution. So you can get quite a bit of money put away into IRAs or Roths. Now, with traditional IRAs, there's a question as to whether or not you can take a tax deduction for it. You can always put the money in, but you might not be able to take a tax deduction for it. And it depends largely if you are participating in a retirement plan through work. So for a single person, the IRA deductibility starts phasing out at 79,000. For a married, it's 126,000. It fully phases out at 146. Um, and so for some people, they might put the money in, but they don't get a tax deduction for it. Other people would get a tax deduction for it. It gets a little complicated if you're making non-deductible contributions to an IRA, because when that money comes out of the IRA, it's not going to be taxable because you didn't take a deduction on it, but you have to keep track of what you put in that wasn't deductible. So in that case, a Roth IRA might be a better option. Um, there's no tax deduction for a Roth IRA, but the money grows tax exempt. And when you pull it out, it's also tax exempt. It's pulled out in retirement and a few special circumstances like first time home purchase or education. Um, Whereas money you pull out of an IRA, it is taxable when you pull it out. And there are thresholds for participating in a Roth. Doesn't matter if you're participating in a company retirement plan, but if your income goes over certain limits, 150,000 for single, 236 for married, it starts phasing out. These are constantly moving targets. There are other opportunities for non-working spouses to be able to make spousal contributions to a Roth IRA or a deductible IRA or a non-deductible IRA. I think your best strategy is to work with your financial advisor and tell them, this is what I made, this is what I participate in work, this is how much I want to put away for retirement. What can I do? And then we can help you determine whether it's deductible or better to do a Roth or can't do any of them, depending on your circumstances. Limits have also increased for business plans, 401ks, 403bs for our school teacher clients, 457 for government employees, thrift savings plans for federal government. Um, for age under 50, 24,500 is the maximum. This is for 2026. And then there's a catch-up provision. Maybe you weren't saving as much as you wished you had when you were younger. And if you're 50 and over, you can put more in. You can put an additional 8,000 in, giving you a $32,500 max of your employer-sponsored contributions. And then in the Secure Act bill from a couple of years ago, they put some other provisions in there. I called it a special age. The government calls it a super catch-up contribution. So if you are between the ages of 60 and 63 in 2026, your super contribution catch up is an additional 11,250. You don't get the 8 plus the 11, you get one or the other. But if you're getting the super contribution catch up, that would give you a $35,750 maximum contribution um, to your 401k or employer-sponsored plan. Then they threw another little wrinkle into the program that started in 2025, continues in 2026. And this would be for high income earners. And this is taken on an individual basis based on your W-2, not necessarily the gross income on your tax return, but your individual W-2. It would apply for 145,000 last year and 150,000 in 2026. So if you fall into that income category and you are making catch-up contributions, either the age 50 catch-up or the super catch-up 60 to 63, those catch-up contributions have to be put into what's called a Roth 401k account. Unfortunately, the government likes to use the same word for things that are completely different. This is not your Roth IRA. This is completely different and separate and has nothing to do with your Roth IRA, but it is an after-tax contribution. So you don't get any tax breaks immediately for putting money into the Roth 401k account. It is tax exempt when you go to withdraw it, just like a Roth IRA would be. So it's not the end of the world. You can still make good retirement contributions. There's still some tax benefits, but they are not immediately in the year of contribution like your pre-tax 401k or employer-sponsored plan contributions would be. A lot of confusion here. Some people think, well, now they if they do this, they can't do their regular Roth, or it has to go into their regular Roth, and don't even try to connect the two. They're really separate. Simple IRA plans for small businesses also get an increase, 17,000 regular. The catch up for 50 plus is 4,000. So that gives employees in a simple IRA a $21,000 maximum. And they get a super catch up as well, an extra $1,250. So there are the limits on those. Let's talk a little bit about retired or required minimum distributions. When somebody reaches a certain age, they are required to start taking money out of their IRAs and employer-sponsored pre-tax plans. This would not apply to Roths, only IRAs and the pre-tax retirement plans. It's called an RMD, which stands for required minimum distribution. The amount you have to withdraw is based on your age and the beginning year balance on your account. Both of those things change every year, and so the RMD amount changes every year as well. It generally tends to increase as people get older, and it generally starts at around 3.75% and gradually gets a little higher after that. Some people are very fearful of the RMD, that it's going to cause a major tax problem for them. And it does create some tax liability, but a lot of times when you look at the actual amount, not as bad as some people might fear. Then for decades and decades and decades, we told you the RMD must start at age 70 and a half. And then the Secure Act raised it to 72. And then the Secure Act 2.0 raised it to 73. So there's a lot of confusion as to when that has to start now. And then to make things even a little more confusing, for anyone born in 1960 or later, their age for taking the RMD out is now 75. So a lot of people in their early 60s maybe are fearful of this RMD and they don't realize it's still many years off for them. But I think there's going to be some confusion out there about this. So again, lean on your financial advisor to see if you need to do something or not. There's something that's called a QCD, that stands for a qualified charitable distribution. And this is where you use your IRA. It's only available for IRAs, not for 401ks or employer-sponsored plan. But you use your IRA to make your charitable contributions. And this can be very valuable if you are in the age where you have to take a required minimum distribution. With the high levels of the standard deduction today, for a lot of people, their charitable contributions are not putting them over the limit of being able to take the standard deduction. And so the standard deduction is more, so that's better to take, but their charitable contributions aren't really helping them on their taxes. If they have their IRA make their charitable contribution, it can then be deducted from the required minimum distribution amount, and effectively you pay no tax now on that charitable contribution. There's a very specific way that the IRS indicates it needs to be done. We do a lot of those for people. Um, so work with your advisor to make sure you follow the correct procedures on it, and also the correct procedures for reporting it on the tax return. But anybody that's charitably inclined is making a lot of donations or even small donations, and they have an IRA and they're in their 70s. This is a very valuable tool for tax planning. And it doesn't even change the amount of money that you're donating. You have to be 70 and a half to do the qualified charitable distribution. So even though you might not be required to do an RMD, you could still do a QCD or charitable contribution from your IRA. Some key changes in the itemized deductions. This would be if your deductions went over an amount that you were able to get more deductions than the standard deduction. So mortgage interest on your primary residence and a secondary residence is still deductible, but you can only deduct interest on $750,000 of loans. The SALT deduction has changed. This is a pretty significant change and should make our friends in California very happy. SALT stands for state and local taxes. So property taxes, vehicle registration taxes, and state income taxes. Um, Part of the original bill in 2017 was to reduce those deductions to $10,000. And for a lot of people, particularly in high tax states, they easily had more in state and local taxes than 10,000. So they were missing out on some deductions. That has been now increased to where you can take as an itemized deduction 40 up to $40,000 in state and local income taxes. It phases out at 500,000 for both singles and marrieds. So not everybody will get to benefit from this, but a lot of people will. There's also a new deduction. Many, many years ago, all interest was deductible. Credit card, car loans, mortgages. And then over the years, they've changed it to where it's only mortgage interest. The One Big Beautiful Bill restored deductions for auto loan interest up to $10,000 a year, and you do not need to itemize to get this deduction. So you could take the standard deduction and still take this $10,000 deduction for auto loans. It's what we call an above the line deduction. But there are some caveats to it. It must be a brand new vehicle and it must be assembled in the USA, and it phases out at certain income levels. It starts phasing out at 100,000 for single, 200,000 for married. I suspect going forward, um, when we see commercials for cars on television, there will be a little subtext to the commercial saying assembled in the USA. Many of the foreign manufacturers, Toyota, Nissan, BMW, they're foreign cars, but they are assembled here in the United States. And some American brands are assembled in Mexico and Canada. So that will be interesting to see how that all works out. I personally can't imagine having $10,000 of interest on a car loan, but I guess some people will. Education and family issues. 529s are still a great tool for saving for children's education. You are able to do 19,000 a year as a current year gift free of any gift tax ramifications. And there's some other provisions where you can actually accelerate that and do 5 years all at once in a 529 plan and not have any gift tax ramifications. Under the new bill, you can now use up to $20,000 a year from the 529 plan. That can be used for kindergarten through 12th grade schools, so elementary school. And then there's a very interesting provision that was put into place. This actually was part of the Secure 2.0 bill, but I think it deserves mentioning here. Any unused funds in a 529 plan can be converted, the term the IRS uses, rolled over to a Roth IRA for the beneficiary. Now, there's some provisions here. The account has to have been open for 15 years. The money has to have been in the account for at least 5 years. The beneficiary has to be eligible to make Roth contributions. I had to explain this to my kids. That means you have a job. The annual contribution limits, the $7,000 a year, 7,500 this year, those limits still apply on an annual basis, and you can move up to 35,000 into a Roth IRA from the 529 plan. Might take multiple of years to accomplish that. This is really interesting when you think about children and from as soon as they get a social security number, you could open a 529 plan for them, fund it for college, then use any additional monies remaining after college to start Roth IRAs, and then those could be used for retirement. It literally gives us a cradle to grave approach of tax exempt earnings on investments, and you can even change the beneficiary where it could span over multiple generations. So I think this is a very powerful trend, and it opens the door. Uh, They've been expanding the uses for 529 plans for many years. It used to just be college tuition, and then they included books and room and board, and then they included any fees like lab fees, and then they included technology that you need to buy. Now they've included uh, prep courses like prep for the ACT or SAT test. Then they included elementary school private school tuitions can be used, money from the account can be used for that. Now they've included Roth IRAs. That could be really interesting over time. And then President Trump made a big deal last night in his State of the Union address about the Trump accounts. He said he didn't pick the name for it, but who knows? But this is a new way of saving in families. It's available after July 4th of this year, and the U.S. Treasury will contribute $1,000 to start the account. Now, the $1,000 from the Treasury are for children born between January 1 of 2025, so retroactive to last year, and December 31st of 2008. So that 4-year window again. There are no phase outs for high income people, and enrollment is automatic. Michael Dell, the founder of Dell Computer, and his wife made a donation of $6 billion to the US Treasury to fund these accounts. Now, in addition to the $1,000 from the government to start the account, families can contribute $5,000 a year in additional contributions to the account. Employers could even put up to 2,500 of the 5,000 in. The employer contribution would be pre-tax. The individual contribution, the $5,000 a year, that would be an after-tax contribution, but it grows tax-free in its growth over the years. At the child's 18th birthday, the funds automatically convert to an IRA for the child, and then the rules for IRAs would apply. And there are provisions in the IRA rules for penalty-free withdrawals for education and penalty-free withdrawals for first-time home purchasers. It will be 18 years before we see any of this happening for the newborns. So I'm not quite sure how the government's going to handle that. I suspect there's probably going to be some modification to IRA withdrawal rules. Um, but this could be another way for families to save money on taxes, get money building for children from a very early age, and is a pretty novel approach. How about business owners and estate planning? Um, the 20% qualified business income deduction has been retained and made permanent. That is very, very important for small businesses, subchapter S corporations. Here's something that is also really important and new. Let's say you're a big company and you are going to build yourself a new warehouse or a new factory or a data center, and you're going to spend many millions of dollars constructing this building. Under the old rules, you could take a tax deduction for the cost of that building, but you would have to spread that cost over 30 to 40 years and take it as what's called a depreciation deduction. Under the one big beautiful bill, the cost of that building can be 100% deductible in the year it's completed. Now, it has to be built in the United States to get that deduction. That is an amazing thing. Um, Prior to the bill in 2017, we had some of the highest business taxes in the developed world, 35%. And with other parts of the world charging 12% or 15%, many businesses were almost forced to move operations overseas. They might have been considered a breach of fiduciary duty to their shareholders had they not done so. The bill in 2017 lowered that tax rate to 21%, which put us in more of the middle category in the world business market. This new 100% deduction spread across different companies now makes us one of the lowest corporate business taxes in the world. That should be very, very good for American companies and also very encouraging to keep production here in the United States. The estate tax exemption, this is an amount that you can pass to other people while alive or through death. So through gifting or bequeathing money out of your estate to someone else, you get an exemption of $15 million per person. So for a married couple, that's $30 million. Some people worry about gift taxes, estate taxes. They become worth worrying about when you're more than 15 million, more than 30 million for a couple. Had the big, beautiful bill not passed, those figures would have been cut in half, and we would have seen many, many family businesses, small businesses, family farms be subject to estate taxes that they now are not subject to. Some things to watch out for. This isn't really part of the bill or part of prior bills. Both of these were part of the Affordable Care Act that was used to pay for Obamacare and the healthcare subsidies. There is something that's called a net investment income tax. This is an extra tax on interest, dividends, and capital gains, and it's a 3.8% additional tax on those kinds of income. It kicks in, it does not phase in, it kicks in at 200,000 for single gross income of 250 for married. And if you have gross income of 250 and $1, it kicks in. So very helpful to stay under those limits if you have a lot of income from dividends and capital gains. There's also something that is called the IRMA premium surcharge. Um, I had I had to do a little search to figure out what IRMA stands for. It's the Income Related Monthly Adjustment Amount. And this has to do with people on Medicare. Medicare has different provisions, Part A, Part B, C, and D. But you pay an extra premium for your Part B section of Medicare. Part B is what covers for doctors and surgery and physicians. And you pay a premium for it when you're on Medicare. It's currently $202.90 a month. For most people, it's deducted from their Social Security check. If your income starts going up over a certain level, it's 109,000 for singles and 218 for married, and this is based on your gross income, you start paying more for your Part B coverage in Medicare. It could go as high from 202, which it is now, to $690 a month. Um, for a married couple that are both on Medicare, that's an additional $11,688 for Medicare Part B. And so, where this becomes critical is sometimes people will want to recognize a lot of capital gains. This is where you got to be careful there. Or they want to maybe convert some of their retirement plan assets, IRAs, 401ks, over to Roths. In converting over to a Roth, all of the future gains on those accounts are exempt from taxes. But the amount you convert, you have to pay taxes on it when you convert it. And in some cases, that could kick people up into these categories where they're getting some unwelcome surprises on their tax return. Some key takeaways as we wrap up. Many of these provisions are going to create meaningful tax savings for a lot of people. Not everybody, but a lot of people are going to get some big tax savings from them. And the rules were retroactive to January of 2025. Most folks have not adjusted their tax withholdings or their estimated tax payments, so they're going to have some really big refunds in the coming weeks. And you know what people do with their tax refunds. They call us up, their financial advisor, and say, hey, we've got some more money to invest. And that's not really what happens at all. They treat it as a windfall and they go out and spend it. 70% of our economy is consumer spending. It's going to provide some pretty serious juice to the economy going into the year in the second and third quarters. Some of these benefits are temporary. They only go through 2028. So planning ahead becomes important, and probably important to maybe review some of these things with your advisor, use some of that tax strategy or tax analysis software that we have to see how these things affect you. And I think there are some long-term aspects to this. This is where maybe I will wax a little bit political in this, so there may be some people out there that disagree with this. But these big refunds are going to be a big stimulus for the economy, as I mentioned. It also creates a tremendous incentive to manufacture in the United States. Low taxes, low energy costs. If you manufacture and sell to the United States, you don't have any tariffs. And as President Trump has been going around making deals on his tariffs and things like that, he's also getting commitments from foreign companies to invest in the United States with new manufacturing. And President Trump is prone to exaggerate from time to time. He says it's $19 trillion of investment. even if it's half of that or a quarter of that, that's a tremendous amount of investment. That cannot hurt our economy. And for every new factory that's built, there's a multiplier effect where people have, they need a pizza parlor, they need a barber, they need an accountant, they need a doctor. So for every dollar that's spent there, there's more dollars spent in other areas. These are long-term incentives. It takes years to build these facilities and get the benefits. But I think it does point us in a direction where instead of the trend being to move manufacturing outside of the United States, it is an incentive to move manufacturing back into the United States. And I don't see where that could be too hurtful, no matter which side of the aisle you're on. There's also tremendous incentives for families. The children's tax credit, the additional children's tax credit, the Trump accounts, the 529 plans. Families with children get some tremendous tax benefits. And that's really important. Our fertility rate in the United States is less than 1.6%. We need 2.1% to maintain the population. And we need to maintain the population to maintain the tax base and the Social Security base and all of those things. So encouraging family creation, family development is probably very good for the country. There's our disclosure statement on all of the things that will take seconds to review. And we do have some time where we can take some questions. So if you want to put something in the chat there, we'll see if we can address it. Well, I'm not seeing any questions, so really happy that you joined us. I hope this was helpful. I hope it was not too boring. Taxes, for some of us, is a terribly exciting subject, but for some of us, maybe not so much. But it is relevant to all of us, and hopefully you can see some areas where you might benefit, some areas where companies would benefit, some areas where our country would benefit as well. And please talk to your advisor. Give us a call if we can help. I do see one question that came through. Oh, it's not a question. It just says, nice job, Jeff. Thank you very much for whoever sent that. I think it was one of our staff. Anyway, we will sign off. We'll be back on with this presentation again tonight at 6 o'clock if you want to watch it again. And it will also be up on our website, Jackson and Whitaker, and it will also be on our YouTube channel. And if none of those work for us, give us a call and we'll send you a copy of it. Have a good day. Thanks for joining us.